Coming up in today's video, we'll be taking a look at the indices, commodities, and currencies and talking about some of the new trends that seem to be forming and whether or not we can trust some of these recent bounce backs in markets, or if the ultimate opportunity is to the downside for stocks and indices and what that could ricochet into other markets. So in today's video, we'll be taking a look at some of the top setups that I'm seeing in the markets right now. Stay tuned. So as we get started, if you could do me a big favor and just hit the thumbs up button on the channel, it does really help just to support my work here on YouTube, and I greatly appreciate it. So last week we had one of the craziest weeks that I've seen in a very long time in the financial markets. We saw the S&P 500 just drop off of a cliff, followed by one of the most impressive bounce backs that I've ever witnessed in my trading career. We saw from the lows in just a few days up 14% on the S&P 500, which is a pretty remarkable move. In fact, 14% on a yearly basis for the S&P 500 would be considered a good year, but we had it in 1 week. Granted, it wouldn't be fair for me to point that out without saying that that's in the context of a pretty ugly stock market, down 21% from the peak to the trough. This is typically what we see. We typically see market bounce backs be the most violent types of up moves in the market. So we see, again, we took out this key level of support, which is now what I really want to hone our focus in on in today's video. You had the fallout here, and then now the retracement. I think we have to be careful getting overly optimistic. Just because we had this bounce off of the lows does not mean we're all good from here and that the market is certainly going to move higher. We still have sellers in control, I would say, of this overall market. You can see by the trend line that I've drawn, tying in these little spike highs that we've seen along the ways. Even though, we had this bounce back, I still think that we are not necessarily out of the woods just yet. From a seller's perspective, you have resistance here that we just marked, some key levels of support, and now the market may be coming back just to fill that gap and retest that area in context of what has been a pretty ugly year so far for markets. That being said, last week we had some really optimistic news. Specifically, we had the inflation number come in at 2.4% compared to the expected 2.6% for CPI year over year. Core CPI also came in very light, and the producer price index came in light, showing inflation is largely cooling in the United States at this time. And a major contributor to this is definitely oil prices, which have been on the fall recently, which helps with the inflation story. If you think about it, if the price of oil is going up, so does transportation costs, and ultimately that trickles down into the price of goods and services. So oil prices recently have been coming down very nicely, which is a good thing for the inflation story. So when we go back to the S&P 500, what am I looking for? Well, we've had some good bounce back news. We've also seen some willingness to negotiate with the United States from many other countries here, although there's still that looming uncertainty about the Chinese-United States trade relations. We see that kind of flared up and get worse in the last week or 2 weeks. Now the question is, will there be enough of a spike here, enough of good news to actually get us to break back into a bullish kind of environment? I think we're very close. That's the thing that I want to point out here with this recent price action, is that you actually have a very close to potentially flipping bullish chart here in my personal view. Key resistance, sellers want this area to hold aggressively, but buyers actually want to see failure here and continuations. Now you might say, well, Nick, you kind of just said it could go up or it could go down, which I commonly address in my videos as something that frustrates me about many content creators in the trading space. So specifically, what I would actually be looking for would be a break back above this resistance point, and then looking to join the move to see if I can actually capture some upside in the S&P 500. And specifically, I also really like the NASDAQ. So I am interested in trading the breakaway move if it does occur. And on the short side, I am not interested, because I think that a lot of this sell-off has been news driven, this uncertainty around tariffs, and many people making big forecasts that the economy is going to crash. And I just don't really love that. And as I've mentioned many times in my videos recently, the put to call ratio is another reason that I'm very cautious trying to get outright short on this market. But I will say this right now, the put to call ratio is at a much more normalized level than it was a week and a half ago. So if you are bearish on the markets, I think the risk to reward got a lot better for the shorts in the last 48 hours or the last 48 trading hours than anything else. Because again, up here, you had everybody convinced the market was going to crash. Now people are more mixed in sentiment. Some people are feeling bullish, some people feeling bearish. There's a mixed sentiment, in which case I think the risk to reward, whether you're bullish or bearish, gets a little bit better. Although back here, the risk to reward was way skewed to the bulls, which is what we discussed over and over on this channel. I personally love to wait for extremes in the put to call ratio, whether it be when everybody is extremely greedy or everyone is extremely scared. And so with a much more normalized put to call ratio, I think that bears may take a stab here. And if there was still, a bearish trend in place, I would imagine that this would be the spot that sellers would take control. So like I said, I'm not going to short the market at these levels. I don't really love the bear case, but I understand that there's a fair case to be made that markets may have more downside, that we may see a new low on this sell-off. But for me personally, like I said, the only interesting trade to me would be a breakout, pullback, and looking for a long side continuation with this downward trend getting beat up. You can see the NASDAQ on the Edge Finder is currently getting a +3 score. But if we get the trend score here to flip bullish, which would happen if you do see a break of that resistance level, that trend filter is going to switch the NASDAQ from neutral into the bullish territory, which will give me the confirmation that I'm looking for to potentially take a long position on the NASDAQ. Other interesting signals that I'm looking at right now are Bitcoin bullish readings, and I'm still long gold, which we'll talk about next. And we'll also talk about some of these currency pairs. The US dollar still getting a very bearish reading, contributing towards this bullishness for other currencies. Here's a look at the gold daily chart, and you can see that you have this big surge to the upside in the last few days, and then now seeing a little bit of a potential pullback starting to occur at this time. But I personally still have my stop loss trailed into profit. I am looking for this 3140 level of support to hold in the instance that we do see a pullback. That's totally fine, but I would like to see continuation overall. Otherwise, I'll cut the trade. So for example, if we see this, great. I'll look to continue to trail stops tighter. But if we do see this level of support fail to hold, that will be my signal to take profits and move on to the next trade. By the way, if we see something like this where we very briefly get a pullback and then it's back through those highs we go, I will look to trail that stop further into profits and just lock in this trade as a winner. And while gold may look pretty stretched, I still think that it has more room to continue to the upside. Otherwise, I would have just taken profits by now. I think that the trend still is intact here, and that the uncertainty surrounding tariffs, uncertainty surrounding what's happening in Ukraine and Russia, and the dollar weakness that we're spotting from the Edge Finder are positive catalysts that can continue to cause this trend to go up. But if it doesn't, I'm going to let price action tell me it's time to take profits. Silver continues to bounce back very sharply here, looking really strong. And copper finding support around the 4.30 level. And of course, oil, which we briefly mentioned earlier, still looking very bearish overall. I'm actually really curious to see if you get a retracement up into this 61.8% zone here, if sellers do actually take a stab at taking this lower from here. Oil is a tricky thing to trade because there's a number of key things that could move this chart. For example, both on the supply and the demand side. From a supply side, if you get wars that break out, the supply gets constrained, causing the price to go up. And if wars settle and we get more peaceful resolutions, that can cause the price of oil to go down because of the increased flow of available supply throughout the world. Typically during war times, there's sanctions, boycotts, all sorts of attacks that can cause limitations to the amount of oil in the global marketplace. And the other key thing is the demand side. And we do see plenty of indicators showing that we're seeing some moderation in the global economy. I wouldn't say that we're seeing a straight up sign of recession globally, but we're seeing signs of a slowing growth global economy, which does not necessarily mean we have to end in recession. You could get growth that looks like this. So growth has been pretty strong. It could slow and then it could speed up again, right? So it doesn't have to, when you hear slowing economy, many people think like, oh, that means like you're going to see an inevitable recession. Does not mean that. We can see economies where you get speedy growth and then flattening out growth and then just really ramping up growth again. So just something to think about is slowing growth is generally just considered bearish for oil, as the demand for economies in the oil world changes based on demand and supply. So as an oil trader, I would encourage you to think about that more closely. And In fact, I do actually have a video on how to trade oil specifically. If that's something that you're interested in, we'll link it in the top right hand of your screen right now. I do also want to mention that the Edge Finder sale is currently ending soon. We have our biggest sale of the year going on where you can get access to all of our tools and data through the Edge Finder. Like I said, it is our biggest sale that we do all year long. You get 40% off. And for those who are watching this video today specifically, if you send us a direct message using the first link in the description, you can actually get 45% off by speaking to a member of our support team and asking them some questions about the tool. If you have any specific things that you're looking for within the tool, we'd be happy to communicate with you and share some information with you to get that extra 45% off. The Edge Finder is a one-time payment to get lifetime access, and that is something that we offer to those who are very serious about this stuff. That is a remarkable offer, since that will allow you to pay one time, and 5 years from now, you could still be using the tool without having to pay another dime. So don't miss this opportunity. It is the biggest discount that we do all year long. Moving on to some currencies, what we see here is the euro dollar up and away here. You can see trading up to 1.14 at one point here. And I actually took profits on my trade around 1.12, and I wish that I'd continued to hold it, but I did pretty well with this trade. I ended up closing for about 400 pips of profit, traded from this area of support here all the way up to this, took profits on Friday here, and I am looking to potentially get back into this trade, but I think it's a little bit overextended. So I'm waiting for a chance to get back into my euro dollar bullish ideas, maybe at this 1.12 level, or the 1.09 level looks even more attractive. 1.08 also looking good. So if we get a pullback, I may look to dollar cost average into the euro dollar long idea once more. And having a very bullish reading on the Edge Finder is nice extra confirmation. We see a COT data, retail positioning, seasonality, trend, most of our economic data readings here favoring the euro over the US dollar, at least at this time. And looking at the top setups economic data page only, this is showing growth, inflation, and labor statistics between the two major economies. In this case, we're doing major currency pairs, so it's the US dollar versus another country or another region or economy. So in this case, the European Union versus the US dollar. Right now, we are seeing some positive leaning scores, especially in PMI data like the services PMIs. We do see also some unemployment data coming in a little bit stronger on a relative to forecasted basis for the euro. And I want to reiterate something with this. This does not mean necessarily that the euro is just the better economy. It means that relative to analyst forecasts, the euro is holding up stronger than the US relative to its forecast. That is a very distinct way that we score this thing. And the way that we've really gone through that has been pretty smart, really. We've really taken a lot of time to look at forecasts versus actual data and build an algorithm that looks through that with the developer team here at A1 Trading behind the scenes. So why am I showing you this economic data page only? Well, the reason we're looking at eco scores only is because we built this page for people who have different trading styles. If you don't really care to look at the trend score that we've built or the commitment of traders data, you may choose to actually just go for the economic data page only, where you can select just to see growth, inflation, and labor statistics for the currency pair or commodity or indice that you're looking to trade. It's a cool new feature, and we've had a lot of people really excited about it. So I'm really excited to bring that to life and allow traders to, again, use the Edge Finder how they want to use it. And there is no set specific way to trade with Edge Finder. It is a multi-purpose tool that helps you scan more data all at once. That being said, most of the major currency pairs, euro dollar, pound dollar, I am looking for retracements as an opportunity to pick up some long positions. I also took profits on Thursday of last week, I believe, my Kiwi dollar position. If this does retrace back down into the lows, I'll potentially look to start another dollar cost averaging long position on the Kiwi. Yields are a bit lower here today, which of course increased probabilities of rate cuts are a welcomed thing in this market, both for risk assets and not so much for the dollar, right? Dollar weakening off of this. We do see the dollar down below 100 at 99.7. Haven't seen that in a while. Trend continues to be to the downside here. And I do kind of favor the idea of selling rips if they do occur in the dollar index. Specifically, I mentioned I'm really liking the euro dollar and the Kiwi dollar at this time for long opportunities, shorting the dollar, buying a counter currency. I do also like the idea of shorting the dollar against the Canadian dollar. If we get a retracement up into this region here, I may be interested in looking to sell this currency pair and maybe adding a second position if we get a move up to like 1.44. And today's video is sponsored by Maven Funding. Many of of you guys may know of Maven already. It's a very popular firm in the retail trading space and allows traders to scale up their trading capital with instant funding as low as just $19. They have some of the best prices in the industry by far, and that is one of the reasons they're one of the most popular in the industry as well. They offer very low pricing on all of their different options, and you can explore them with the link in the description down below. They also offer very fast payouts, and I saw on their site that it's under 1 hour usually on average, which is pretty cool. So if you're interested in getting funded and want to explore the different options they have with their very low cost approach, you can take advantage using the link in the description down below to explore those discounted prices. One of the coolest things I think about having a low cost approach to getting funded is that it allows traders to experiment a little bit, and if you mess up, it's a small amount of money that you're putting on the line to try to get funded, as opposed to some of the more expensive options out there. Maven allows you to have a lot of flexibility, do what you'd like to do, but their funding costs are not nearly as expensive as some of their competitors. So like I said, explore Maven down below in the description. My nightmare story in dollar cost averaging was with the euro against the Australian dollar in 2020. I was short the euro against the Australian dollar, and for a long time, I made very good money doing this, right? So I'd short it, take profits along the way, long, take profits, short, take profits. You know, I did this very profitably for a while, 2019, 2020. Well, 2020, volatility expanded. The VIX went crazy. And this is why I always say the VIX does not just pertain to options traders. It pertains to everyone. Forex traders, crypto traders, commodities traders, doesn't matter. The VIX matters to everyone because the VIX expanded like crazy in 2020. And this is what happened to the euro against the Australian dollar. So again, I was making great money trading back and forth, dollar cost averaging, taking profits, dollar cost averaging, taking profits. Look what happened in 2020. You tell me how you think I did in that kind of move, dollar cost averaging without a stop loss. Nick, you idiot, what were you doing? Well, I actually had small sizing. I was doing it with small size. I had 0.05 lots per trade. So I was 0.05, 0.05, 0.05, and I was trading for the reversal. I still do this to this day. You might say, Nick, you're insane for still doing something like that. I still do it. But let me say that this humbled the life out of me because it showed me I need to go back and watch these streams from these times because I was not okay. Like mentally, I was like, holy crap. I thought I was being defensive. And I ended up doing okay with this trade. I actually ended up closing for like a couple $1,000 profit in the end. But oh my God, did I have to earn that? It was absolutely painful because what happened during that time was that when the world was planning to shut down, the Australian dollar, in a scenario where the world shuts down, it's not a place to be because they're a commodities-based economy. So if they're selling, iron ore and copper and all that stuff, and then the world shuts down, that's not good for the Australian economy. So the euro massively jumped against the Aussie dollar, and I rode that baby. But the only reason I didn't blow up is because my size was tiny compared to the trading account I was working on. By the way, just when you think 0.05 lots, you think that's a small size position? If you had talked to me, I wasn't in a very good mood at that time. And I can tell you that ain't a small position when the markets are moving like this. It's all relative. That's why the VIX matters. When the VIX is really high, a 0.05 lot size can be a huge position and you didn't even know it. So I learned a lesson during that. Like I survived that and I didn't ever get past my point of no return. Like I do have, when I dollar cost average, I have like a 40% drawdown like limit in my aggressive Forex account. Like 40%, if that triggers, I'm all out. I think I got to like 29 or 31%, somewhere in that range, peak drawdown. And I was like, yeah, if this keeps going, that is going to have to be, I'm going to have to basically wipe away all the gains that I've made in the last like 2 years. And that's going to suck. But it didn't happen. The market did ultimately reverse and I was able to get out. But 99% of traders would have been too big and would have blown up way sooner than that. So it just is the importance, if you're going to dollar cost average, what you think is a small position may be a very large position. Even 0.01 lots in a certain currency pairs, like Euro Aussie is not a joking, that's not a currency pair to play around with. That thing is very volatile. Like even this move that we're seeing now, it's a 2,000 pip move. So choose the correct currency pairs. If you're a Forex trader, choose the correct lot size. If you're a NASDAQ trader and you're trying to dollar cost average, I really think you probably shouldn't be trading on a CFD brokerage. You should probably trade trade like ETFs. That's my personal opinion. If you want a dollar cost average, QQQ is a great, it only takes $461 to buy a share of this. So you could theoretically buy one share for $500. You're $500 in, buy another share at $400. That's $900 total invested. That's a $900 max dollar risk, right? If the NASDAQ were to go to zero, which if the NASDAQ goes to zero, we got way bigger problems than trading. Like the world probably ended.
I hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.